Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. In the past episodes, we've talked about the basics of insurance, including renter's insurance, disability insurance, car, and health insurance. And today we're going to hit on a big topic, life insurance. So let's start with the obvious. What is life insurance?
Okay, life insurance is something that pays a benefit in the event that someone passes away.
So
very simply,
that benefit would then go to their family members? Or
to what's called a beneficiary.
Okay.
So whoever has been named as that beneficiary, that person will
Gets
receive the benefit of it. Yeah, that's correct.
And now, are there different types of life insurance?
There are many different types of life insurance. It's actually a fairly complex area. In big picture terms, one is called temporary or term insurance, and the other type is called permanent or permanent insurance. Okay, temporary insurance basically means that the insurance is intended to be there for a short period window of time, maybe up to 15 years or 20 years, something like that. Think of it as you have a child that's 10 years old maybe, and you want to have enough money in life insurance so that by the time the kid is 22, should the breadwinner, let's say, die in that time period, there'd still be enough money to pay for college and help get the child through on expenses and set them up in life, whatever. That's a term or temporary period of time. It's 10 or 12 year window. You don't need it after that because the child presumably is now going to go out and start a life of his or her own. Permanent insurance is a kind of insurance that you want to make sure is there at whatever point the person passes away. Typically, you're trying to make sure it's there when they are elderly and pass away, okay? The kinds of needs that permanent insurance typically fills could be something among these kinds of things. First, let's say I want to give a gift to a charity. I want to leave $1 million to a charity, but I don't want to give them $1 million. What I want to do is give them a certain amount of money every year and let them deal with it. So if they buy a life insurance policy, if I die 3 days after I start the life insurance policy, or if I die when I'm 110, they're going to get $1 million. So you're guaranteeing that they're going to get that money. In effect, is what you're trying to do, no matter when the person dies, whether it's early or elderly. Second kind of a use for it would be, from an estate planning standpoint, there are sometimes taxes due when a person dies or at the death of the second of two people. That estate taxes are due to the federal government and to the states. Okay, and not a big deal for most younger people, but insurance of a permanent nature is usually used to try and pay for those taxes later on. If, say, a couple, passes away and there are taxes due on their estate, because they can give away a little bit of money, use a little bit of money to buy an insurance policy, and have it covered whether they die sooner or later. So, but those are called permanent needs, because no matter when those people die, whether it's within 5 years or 10 years or 12 years or 30 or 50 years, those needs still exist. So when it comes to the term versus the permanent, you kind of get the sense of, some of them are for shorter term windows and others are for permanent.
I want to go back to term and talk about, does the benefit amount differ since you're only putting in the premium, your payment, for a shorter period of time? And what happens if that person does pass away while they have term insurance?
Okay. Well, to answer the second question first, what happens, the benefit is paid out exactly the same as if they had permanent insurance because the person has died. So in either case, the person has died. The policy costs far less for term insurance if you start it now and hold it, have it for 10 years or something like that, than if you start a permanent insurance policy now. But the difference is that if you were to try to hold that term insurance policy later in life, it will become prohibitively expensive. I mean, like $1 million policy might be $100,000 when you're 80, and 200,000 when you're 85, and 300,000 if you make it to 90.
Like each year, you mean?
Every year, going up to numbers that are just exorbitant. But the thing is that you're more likely to die. So temporary insurance is it's really very, very similar to what is the risk of a person dying in a given year. That's what temporary insurance is like.
And since it's lower.
It's lower when you're younger, right? Because there's less chance of dying. Correct.
I see. Okay.
That's correct.
And then say you decide to end your term insurance policy, you just can move on to a different permanent policy?
You can if you have a permanent need, but you may not have a permanent need. You may no longer need life insurance. Imagine a couple that reaches age 65 and now they're ready to retire. They have enough money to live out the rest of their lives and to leave some money for their children or grandchildren, but they don't have so much money that there are going to be taxes on their estate later on. Those people may have no need for life insurance whatsoever. You could buy some life insurance to pay for your funeral costs, but if you have enough money to pay your life and to pay for, children and grandchildren, you have enough money to pay for your funeral. Yeah. So insurance is not necessarily a luxury. It's designed to be a necessity. Okay. So you don't have to have it simply because there's a risk. You have it because there's an insurable risk that you can't afford. Yeah. That you can't afford to leave not taken care of, basically.
So then, how is the amount of a policy decided? Is that something you choose? You decide this is how much money I want to be able to have later, so I need to put this in each month, or how is that decided?
So the way to decide that is based upon what you perceive that need to be and what that cost is of that need. So it makes no sense to just say, I want $1 million of insurance, without saying, well, why? For what need? So part of what financial planners do is they help people quantify these needs. So for example, I have 2 needs for life insurance. I'm 40 years old. I want to cover my spouse for $5,000 a month from now through the rest of her life. The second thing I want to do is make sure that there's enough money to take care of my children and to put them through college and maybe give them a little bit extra after that. So that's what I'm buying this life insurance for. Okay. How much does it cost to do that? Yeah. Mr. Financial Planner. And the financial planner's job typically is to do that. Now, there are plenty of online systems you can actually go to today and do the same. Like a calculator almost? An online calculator and put it in. A lot of the insurance companies will have it today. So you can go in and try to figure that out. Now, that might come back and say that you need $3 million, not $1 million. It might come back and say you need $500,000 or $300,000. But it's more important to get the right amount than it is to get an amount that you can afford or an amount that sounds nice, like a big, nice round number. Yeah. Some people like to, I have $1 million of life insurance. Well, okay, what if you need $2 million? Or what if you only need $500,000? Yeah. And that's where really getting some good advice and some proper analysis of it comes into play. I can tell you, in my career, I've met many people who were not properly insured. There was just an amount purchased randomly, in essence. Yeah. So no, it makes total sense that you would need to take into account what you're actually trying to leave behind to decide what to put into what the purpose is for the money and how much that costs to do it, how much that will cost over time, let's say, to do it. But those are financial calculations that typically financial planners are trained to do. So at the end of, let's say, a permanent life policy, someone passes away, what happens to that money? Okay, well, whether it's a permanent policy or a temporary policy, if someone dies, if a policy ends, what happens is that the people who are settling the estate of the person that died, or who someone who's the beneficiary of the policy, if they know that they're the beneficiary of the policy, what they will do is they will typically call the insurance company and say, this person has passed away, what do we do now? Yeah. And what has to be done at that point, it varies by state to a certain degree, what paperwork would be needed. But in general, what's going to happen is there's going to be a request from the insurance carrier for a death certificate to prove that the person has passed away, right? There might be something called an affidavit of domicile of the person that passed away.
What's that?
It basically is a thing that says, yeah, this person lived in this state at the time of their death.
Okay.
And it just has to do with the estate planning in general.
Taxes.
Yeah, it's not really critical to life insurance in general. And there may be a form that says, I want to receive this benefit in the following way: a lump sum, or I want you to just start paying me interest off of it. I mean, there can be different things, different ways that you take a benefit from life insurance. So that all gets processed and put in. And if it's a lump sum, generally speaking, you're going to find a check in the mail. The beneficiary is going to receive a check in the mail, and then it's free to do with those funds as the beneficiary chooses.
So we've kind of talked about the lifespan of a policy and what happens when it ends. I'm wondering, do you have to pay taxes on, the money that you're putting towards a policy, a premium, and do you have to also pay income taxes if you're receiving someone else's benefit?
The answer to the first one is yes. The second one is no.
Okay.
So when you pay a premium on a life insurance policy, that premium is not income tax deductible. Now, generally speaking, it's not tax deductible.
Okay.
So if you have a $1,000 premium, you have to earn your $1,400 and pay $400 in taxes, and you have $1,000, and then you can pay the premium for it. Because that's not tax deductible, the benefit is also not income taxable.
I see.
So if you inherit $1 million life insurance policy from somebody, that is not income taxable to you. It's effectively it's considered to be a gift. That's really what it's considered to be. And gifts are not taxable to the person who receives a gift.
Okay.
So you get $1 million, and you're free to do with the full $1 million however you choose.
So now I've got a few terms that I've heard of, but honestly don't really know much about.
All right.
What is a cash value?
So a permanent type of life insurance, typically what defines it is that you're overpaying for it in the early years and underpaying for it in the late years of someone's life. When you're overpaying for it, what's happening is some of the money is going to pay for expenses of the policy, some of it's going to pay for the insurance cost itself, but a chunk of it is also going into some sort of an investment pot, if you will, okay? And that pot is invested over a period of all of these years, and it grows and it helps to cover the insurance costs later on when the person is elderly. So cash value is the term that refers to the value of that cash pot that you're building up inside that policy because you're overpaying for it, in effect, again, in those earlier years.
So you kind of overpay at the beginning, and then the investment helps it grow so that you don't have to overpay as you get older.
You don't have to pay as much as you would for the risk when you get older, yes.
I see.
Yes. If you remember, the term insurance gets very expensive when you get older.
So it almost
The other type of insurance does not.
Does it make it more affordable then when you are older to be able to pay into it?
Absolutely.
Yeah.
I mean, if you had to pay $100,000 for a life insurance policy, and then you lived, and then next year got to pay more. I mean, at a certain point, you might just say, "Forget it. I'm going to drop the policy. I'm not going to keep paying this."
You're putting all your
and then
money
you've
into
wasted all that money that went before it.
Yeah.
So this kind of policy, the permanent kind of policy, was created to fix that problem. Term insurance is great if you die early. Permanent insurance is better if you die late, if you live longer.
That should be the slogan.
Woohoo!
Let's talk about what's a dividend.
A dividend, okay. So insurance can be what's called either participating or non-participating. What that means is that in some instances, the insurance company shares back with its policyholders some of its profit. That would be a participating policy. You participate in the profit. And that profit that comes back is called a dividend. So it's like reducing the premium cost, the effective cost of the policy.
Do you get paid that back with on a regular basis, or is that something that comes back?
It's typically something that's declared once a year.
Okay.
So now some people will take it as a check. Other people kind of reinvest it into the policy conceptually if it's a whole life policy, a permanent policy.
Yeah.
Some people will use it to do what's called buying paid up additions. Don't get yourself lost in the term. What it means is that you're buying a little bit more insurance with it. Just a little, you're taking that and purchasing like a one-time paid up policy with that money.
Okay.
So it just helps to add to the value of the policy over time, in case that's what your goal is with the policy.
Okay. Well, that wraps up all of our insurance videos. We hope that insurance is feeling like an easier topic to grapple with. I know it can be really complicated, but if you just take your time and focus on what's important to you right now, it should be totally doable. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.